Ladies and gentlemen, good day and welcome to the Kotak Mahindra Bank Q3 FY22 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Uday Kotak. Thank you, and over to you, Mr. Kotak.
Thank you, and good evening, colleagues. I wish you all a very happy new year, and hopefully 2022 calendar will see the end of COVID from being a pandemic to an endemic. I'm very happy to share with you the financial results of Kotak Mahindra Bank. On a consolidated basis, we have had a profit after tax growth of 30% year on year. And I'm extremely happy to share that our business model of concentrated India diversified financial services is working well. As you know, we are in a broad range of financial services, which includes banking, securities, asset management, investment banking, insurance, and financing. And we're seeing a very strong growth across the different segments of financial services. As you are aware, our group also owns 100% economic interest in all these businesses. If you look at the mix of our consolidated profits, the bank contributed 63% of Q3 FY22 consolidated profit. And we look forward to a broad continuing performance of the overall consolidated profits of the bank. Coming specifically to standalone banking, I'm happy to share that we are going for growth. Growth in our advances is 18% year on year, and interestingly, 8% Q on Q. Our consumer bank grew at 29% YOY and 10% Q on Q, which is nearly 40% annualized. So the overall advances engine is now working well. Another significant step in our growth trajectory is the step up in our customer acquisition. We added 21 lakh customers in Q3 22 versus 8 lakh in the same quarter last year, a nearly 3x growth in new customer acquisition. As you can see from above, we are focused on growth, even if it puts some pressure on operating expenditure in the short run. Another very important aspect is...
तुम्ही ज्या व्यक्तीशी बोलत आहात त्याने तुमच्या कॉलला...
Hello?
Yes, sir.
Hello? Yeah. Another important aspect of our performance is asset quality. And we are quite enthused with the outcomes at the end of quarter 3. At the bank standalone, our annualized credit cost on advances is now 35 basis points. Of course, excluding the reversal of COVID provision. The slippages for the quarter are down to 0.3% of advances. In fact, recoveries and upgrades are much higher than the slippages. And the standard restructured fund-based outstanding under all frameworks, COVID, 1, 2, MSME resolution framework, is 0.54% of the advances. So we are actually seeing a significant improvement in the asset quality and the quality of our balance sheet. Next, and this is an important item, as we see interest rates moving up, the overall duration of our fixed income bond book is at a low of around 1.5 years. Having said that, we have a very large part of our fixed income book which is not in HTM. As a result of which, in the Q3, we have taken a mark-to-market provision through the P&L of 484 crores on this account. But going forward, with a relatively low duration of our fixed income bond book in a rising interest rate environment, we feel our bank is very well positioned from a risk matrix point of view. Further, as interest rates move up, we believe strategically a high CASA ratio of 60% will be very, very handy. And all this is in the backdrop of our NIMs now at 4.6%. Also important, if I go back to the consolidated numbers, our return on equity is now at 15%, keeping in mind, despite a high capital adequacy of 24%, including the profits, of course, for this current year. Therefore, at a very high capital adequacy of 15% ROE, and also if you look at the nature of risk we carry on our balance sheet, we think it's a very measured and well moderated and structured risk we are carrying. So all in all, we think we are well geared for 2022 and beyond, and happy to continue with the strengthening of our broad financial services model. And we believe different engines will fire at different points of time, and that is the core strength of our business model. With that, I will now hand over to my colleague Jaimin Bhatt and thereafter to other colleagues to take you through the various aspects of our financial performance. Over to you, Jaimin.
Thank you, Uday. Let me start with the consolidated numbers. And as Uday mentioned, we closed this quarter with post-tax profit of 3,403 crores, a 31% growth on a YOY basis. And as we can see, the bank contributed for this quarter 63% of the overall profits of the bank, of the consolidated entity, which is down from 71% in the same period last year. As Uday mentioned, we own 100% of our subsidiaries, and a number of our subsidiaries actually do not need the capital which goes with the growth of their businesses. But nevertheless, each of the segments in the subsidiaries have actually grown pretty well in this period. The lending entities, which includes Kotak Prime, did pretty well in terms on the back of improved collections, also coming in after taking the hit on account of the increased provision requirements thanks to the RBI change. So Kotak Prime ended the current quarter with a profit of 254 crores as against 149 a year ago. The other NBFC came out also again clocking in a profit of 111 crores. The capital market entities going on the back of buoyancy in the markets, Kotak Securities recording a 270 crores profit, and the investment bank, which is the KMCC, bringing in a record 103 crore profit. They've been engaged in several market deals during this period, both on the IPOs and the advisory side. Life insurance, which had a negative first quarter this year, has clocked in 247 crores this quarter compared to what it did a year ago, which was 167 crores. The mutual fund businesses bringing in close to 150 crores post-tax profit this quarter, to an extent helped by some investment gains in the trustee company, which is at pre-tax level of 46 crores. As Uday mentioned, we end the period at the consolidated level with a capital adequacy of 24.5%, which includes Tier 1 itself of 23.7%. A pretty healthy ROA of 2.6% at the consolidated level. At the bank standalone level, as we spoke about, the post-tax profit ended with 2,131 crores, which is about a 15% growth on a year-on-year basis. Our net interest income grew about 12% on a YOY basis and about 8% on a QOQ basis on the back of advances growth, which came at 18% YOY and 8% QOQ. If we add the credit substitutes, the total growth of credit has been at 20% on a YOY basis. And the growth has come across the board in the consumer segment, the commercial segment, and the wholesale segment, which my colleagues will take you through as we go forward. The net interest margin on the back of a high CASA of 59.9%, again continuing to be pretty healthy at 4.62%. Our fees and services has continued to be a good growth area, a 33% rise on a year-on-year basis, coming on the back of improved revenues both on the distribution front as well as in the general banking area. As I talked about the mark-to-market book, we have our bond book duration is at 1.58 years, but a large part of our book is in non-HTM. Our HTM portfolio is 38%. As a result, the non-HTM book, we had to take a mark-to-market hit as of the end of December on the back of the rise in interest rates. That has meant that we've taken a knock of 484 crores on the MTM loss for this quarter. We have seen the employee costs go up this quarter on the back of a family pension provision, which came out of the bipartite settlement which the IBA entered into with the bank unions. That has been a hit of 100 crores for this quarter. And again, as Uday talked about, we have continued our push for growth, and that has meant continuing to have expenses in certain areas. Apart from growth of employee costs, this has meant rising costs on the customer acquisition side, both on the liabilities and assets. We also had increased advertisement and promotional costs, as well as cost increase in the whole tech spend. And as we saw, the customer increase this quarter at 21 lakh is significantly higher than what we did a year ago, which was 8 lakh. Our asset quality has improved over this period. Our absolute GNPA went down from 7,658 crores to 6,983 crores. Our slippages during this quarter was all of 750 crores, whereas against that we saw recoveries and upgrades of over 1,000 crores. And this is the second quarter in succession where we've seen slippages lower than recoveries and upgrades. Our credit cost down to 35 bips without taking the COVID write-back provision. Our SMA2 continuing to be low at 298 crores. Our overall restructuring, again, we've been careful, and if I look at the standard restructured book, whether it was through COVID-1, COVID-2, MSME resolution framework, all put together is 0.54% of our overall book. On the back of improved realization on the problem assets, we took stock and we have written back COVID provision of 279 crores. We continue to carry 1,000 crores of COVID provision on our books still, and our overall provision numbers today are higher than what we see as the GNPA number. So after all this, we end the quarter in the bank with a post-tax profit of 2,131 crores, which is about 15% higher than the same period last year. I would request Manian to take up the corporate bank assets after this, please.
Hi. As we usually do, let us look at the corporate assets in two parts, the SME part and the regular corporate bank side. On the SME side, as you can see, the momentum of growth continues. With YOY growth is about 21%. Our NTB acquisition remained robust through the quarter, and we can see this momentum carrying forward. On the corporate side, you need to look at the number along with credit substitutes figure that is reported there. If you look at a combination of the two, the assets have gone up from 77,581 crores to 86,659 crores, the sum of the two. That's close to 15.5% kind of growth. So overall, the segment, the corporate and SME together have grown at about 16.5% YOY. In the case of SME, while the NTB was good, we also saw some small uptick in the utilization numbers. However, we are not yet seeing any pickup in term loan kind of products, and we are still seeing traction on the working capital side. At the top end of the corporates, which is the conglomerates, growth has been driven more by credit substitutes than by advances purely. Advances growth is muted, but the combination of the two was quite healthy. And even there, we are seeing growth driven more by working capital than by long-term loans. Even the next rung of corporates, what we call large corporates, they seem to be following the trend that the top-end corporates and conglomerates followed. Relatively, we have seen uptick in the credit substitute side there as well. In times like this, when pricing pressures are high, we find credit substitutes as a better method to do some of these lending. Overall, within corporate bank, NBFC as a segment saw some uptick again, probably because mutual fund credit funds were not available as a source to them, and they came back to banking sector for borrowing. On the CRE side, while we remain cautious on the commercial side, we have seen very good traction on the residential real estate. And as you can see, the QOQ on this has been significantly better than the YOY on the residential real estate side. And more than 80% of our new disbursements are on the residential sector. Between the sub and the bank, I think this segment credit has revived, and we see growth going forward. Of course, we are keeping our focus on the top end, and there are a lot of new customers we are able to add in this segment. Apart from this, our focus on transaction banking continued. We went live on our online trade portal. We created a new CMS platform, and migration of customers onto the new platform is in progress and is progressing quite well. Several new features were launched during this last quarter. And overall, trade, FX, CASA, and DCM fees, all the non-risk revenues have done quite well through the quarter. We are also our custody business during these times when there has been an IPO, string of IPOs has also done extremely well to help our CASA growth. Overall, the health of the business remains good. The ROE and risk-adjusted returns, RAROCs, remain good. And the asset quality, of course, Jamin already talked about, remains quite healthy and in all segments of the business. And we look forward to a good momentum carrying forward from. Thank you. Can I hand over to Kannan? Kannan, will you please take on?
Mr. Kannan, please unmute your line from your side.
Thank you, Manian. I will start with the commercial vehicle financing business. Heavy commercial vehicle sales further improved during the quarter as compared to the previous quarter. Capacity utilization in the goods transport segment was better than the previous quarter. Cash flows for the transport operators was better due to a combination of better utilization, lower fuel prices, as well as stable freight rates. Our disbursements are in line with the better performance of the vehicle sales. Passenger transportation, staff transportation, and school bus segment continue to be impacted. Collection efficiency on demand in this business has been good during the quarter, and it's been better than even the previous quarter. Demand for construction equipment is good, both in the roads and the mining segments. It continues to be good, driven by government contracts. Demand for smaller equipment at the retail level has been a bit muted during the quarter. The retail customers, the smaller customers, have been impacted by the long receivable cycle, and hence addition of new equipment is a bit slower there. Capacity utilization of equipment again has improved over the last couple of months, which should lead to improved cash flows for the entire industry as a whole. Collection efficiencies on demand again here has been good, and it's as good as normal time. Tractor sales during the quarter has been better than the previous quarter, though lower than the same quarter last year. Rural cash flows continue to be strong, though a bit delayed in parts of the country due to the prolonged monsoons. Our disbursements on the tractor finance segment has been good, and we continue to maintain our leadership position in the segment. Strong cash flows should lead to continued good demand in the coming quarters. Collection efficiency on demand has been good again in the segment. On the agri finance segment, demand for credit, both working capital and capex in the agri SME and the agri value chain continues to be good, aided by good monsoons and increasing commodity prices. Collections during the quarter has shown an improving trend as compared to the previous quarters and is closer to normal time. Our microfinance disbursements have grown as compared to the previous quarter. Demand for credit from micro and small entrepreneurs continue to be strong in the markets in which we operate. Collections in the market we operate are improving, and collection efficiencies are as good as normal time. I will now hand it over to Shanti to take it through the consumer bank, please.
Thank you, Kannan. In continuation, I will start with lending. Consumption saw a good uptick in the quarter, being a festival quarter. All our retail lending businesses showed robust growth in Q3. This helped us gain market share in many products. At a consumer asset aggregate level, we grew 29% YOY and 10% QOQ. This is on the back of a 10% QOQ growth in Q2. Mortgages. We had our best ever quarter on fresh volumes for home loans. A price leadership campaign of 6.5% during the festival season helped us acquire quality customers and strengthen our market share across all the customer segments. We continue to strengthen and widen our distribution in this very key focused business area. As the business momentum picked up, we also saw good volumes in LAP. We saw a pickup in some commercial, but more on industrial property purchase for self-use. We continue to consolidate our market share in LAP. Mortgages grew at 38% YOY and 12% quarter on quarter. Unsecured retail. We start with cards. We had one of our best quarter on cards with acquisition at 3.9 lakh cards. Bulk of the sourcing has been from existing customers. We rolled out attractive offers to our customers in marketing alliances across e-commerce and physical partners across the country. Our Kushi Ka Season campaign and brand ties with Apple and OnePlus has helped us deepen our engagement with our customers. We operationalized our co-branded partnership with Indigo. We continue to invest in technology, distribution, and strong product propositions to grow in this space. Personal loans. We had our best ever quarter with monthly originations of 1.7x of pre-COVID levels. A large part of the new loans is sold digitally. We saw increased demand as normalcy returned from segments like weddings, home, renovation, travel, etc. We have scaled up our new acquisition in both traditional and data-led digital space. We migrated to our new Salesforce platform for origination in this quarter. And in phase 2, our DIY and STP journeys will go live in the upcoming quarters. Consumer finance, one of our best quarters thanks to the festive season demand across physical and digital distribution. We continue to scale in this space through widening distribution and relationships with key partners and a strong data-led digital business. Overall, unsecured retail business saw a YOY growth of 12% with a strong quarterly growth of 16% on the back of 12% QOQ growth last quarter. Working capital and business banking. This quarter saw an increase in credit demand due to better business volumes and capex demand from select pockets. Export segment continued to see demand from specific market clusters. We focused on new quality client acquisition, both in the secured and unsecured space in the MSME segment. 85% of the book qualifies for our priority sector. We will continue to grow in the MSME space by expanding distribution footprint, multiple and deeper channels and technology enablement. Collection, our bounce rates and resolutions continue to be better than pre-COVID levels. As we shared last time, we launched our digital customer collections platform, where we saw higher customer adoption, and over time this should help us reduce our collection costs. We have invested significantly on the customer and consumer assets business across distribution, technology, data and analytics, and aggressive customer offers and propositions. We will continue to invest in this space. Now to deposits. Average savings deposits grew year-to-date YOY 11%, current account at 32%, and sweep term deposit 20%. The focus on acquisitions, as you saw, aggressive customer acquisition continues on granular retail customer growth across digital and physical channels, and 811 continues to contribute successfully to our digital customer acquisition. The bank had 30.7 million customers as at December 21 versus 25 million last year. Our CASA ratio was at 59.9% as at December 21. Our TDs below CASA and TD below 5 crores comprise 88% of the deposits. TD sweep deposits was at 7.6%. Our cost of staff was at 3.5% this quarter versus 3.81% in Q3 last year. Our asset cross-sell in Q3 through the channels were very strong across all retail products, both in consumer and commercial asset space. Fee income showed good growth, including in insurance, investments, and brokerage. We have increased our market share in issuance of FASTag to 10% for December 21 on a monthly incremental basis. We launched a co-branded debit card with PVR during the quarter, and we are seeing increased customer engagement. Now to the digital part of our strategy. As outlined in the previous quarters, our digital strategy and initiatives are centered around our customers across acquisition, engagement, and service, and across our value proposition of saving, lending, payment, investment, protection, powered by AI and ML. We continued on each of the aspects of technology, infrastructure, applications, and DIY customer journeys towards scalability, agility, and reliance. In the digital channel, we will be going live with all our key consumer asset DIY and STP journeys in the coming quarters, providing a seamless, frictionless, and convenient experience for our customers. And this investment in our tech stack will be a continuous journey and a backbone of our digital strategy. Mobile first has always been a key strategy. In the last 2 years, we upgraded our mobile app significantly by providing customers more functionalities and a greater choice across banking, payment, loans, and cards. In Q3, we launched many functionalities across assets, payments, lifestyle, protection, and risk. Our customer-centric experience and functionality has allowed us to be consistently amongst the top-rated banking apps in both iOS and Android. We have seen significant increase in monthly average users, which has grown 37% YOY, transaction volume, which has grown 126% YOY, and value 53% YOY through our mobile banking channel. In retail assets, we have been working on enabling mobile first, and in Q3 launched several functionalities across home loans, cards, and revamped the entire loans module in the app, making it easier for access to customers. On the payment side, UPI transactions have grown 3x December 21 over April 21, including P2P and P2M transactions. Pay Your Contact continues to see rapid adoption, and we saw a 6.6x growth in transaction in December versus April this year. That was when we had launched this. In merchant acquiring, we embarked on the path of delivering a complete bouquet of e-services with the launch of our merchant app, Kotak Biz in Q2. This helped us onboard merchants for payment and collection services digitally, serve them digitally, and deliver targeted offers on multiple banking and value-added services. In Q3, we enriched the digital onboarding by extending it to our existing current account customers and added new features. We have gone live in our partnership with EasyTap to increase our merchant acquisition footprint and service their merchants. To help our merchants in managing their cash flows better, we have introduced the same-day settlements in this quarter. And we, in this quarter, continue to leverage our partnership with Pine Labs for new acquisition. Ecosystem. The strategy on ecosystem is in 3 parts: orchestrate, partner, participate. In Q3, we added 4 new partners in Kmall, including Myntra, in the in-app shopping mall. In Q3, we continued building on our API stack for partners. We have 391 APIs live. As of now, we have 298 registered partnerships. Some key names include Pine Labs, Vivify, Setu, amongst others. We are rapidly expanding our fintech partnership network and are experimenting use cases and business models. We plan to leverage the regulatory network of account aggregator and open for retail and SME lending in the upcoming. Now to the corporate and business banking stack. We've upgraded our transaction banking tech stack towards transforming customer experience in trade and cash management products. Trade portal. We launched a paperless end-to-end seamless trade portal, creating significant differentiation to meet our customers' unfulfilled needs. Customers can transact for outward remittances, import LCs in collection, export LCs in collection. We will be going live with an inward remittances, pre and post shipment finance tool. We have seen active adoption by customers and have received very positive news. We migrated 14,000 plus customers to our new CMS portal, which is simple to operate with superior interfaces and customer experience. We offer full stack digital capabilities on a host force and API solution basis, which again has created a significant differentiation in meeting our customers' needs. On the transaction banking side, we introduced many services with enhanced user experience. Talk about some. Our corporate mobility app 2.0 saw 17 plus lakh transactions, which is a 46% YOY growth for YTD December end. We introduced BBPS Click Pay, a new feature in BBPS which speeds up the transaction processing with a one-click journey. We introduced CMS 24/7 for corporates via APIs and with advanced payment architecture, allowing them straight-through processing. We introduced paperless supply chain financing on e-way bill data verification. We partnered with a fintech for international acquiring BIN sponsorship for cross-border transactions that helped us provide a superior international payments gateway to key e-commerce customers. We will continue to invest in the tech stack for a superior experience for our business banking customers. Digital transactions through mobile and net continue to grow across deposits, lending, service, and transactions. 97% of our savings volume transactions were in digital or non-branch mode even in this quarter. I now request Gaurang Shah to take you through the insurance business highlights.
Yeah. Thanks, Shanti. Let me take you through the financial performance of Kotak Life this quarter, a quarter with more normalized environment for life insurance business. Our gross written premium for the quarter increased to 3,108 crore from 2,223 crore in the previous year, showing an increase of 18.5%. We continue to maintain a balanced product mix between participating and non-participating products, channel mix of agency and bank assurance, and also between the individual and group business. Individual APE growth for the quarter was 31.6% against the private industry growth of 27.5%. Group business for the quarter was up by around 28% on the back of protection business growth of over 60%. Overall claim experience continues to be in line with the excess mortality claims we estimated in June 21. We carry adequate provision to cover future expected claims if something arises out of Omicron. Overall, a 600 crore excess mortality hit for the year, net of reinsurance. That has been the hit which we have taken. Our net worth has crossed 4,000 crore with strong solvency margin of 2.66 times. Now I hand over to Jaideep to take the presentation forward.
Thank you, Gaurang. The top line for Kotak Securities is 656 crores for the quarter ending 31/12. This is comparable to 613 crores for the previous quarter and 474 crores for the same quarter last year. The profit before tax for this quarter is at 359 crores. This is again comparable with 325 crores for the previous quarter and 245 crores for the same period last year. And the PAT for the quarter ending 31/12/21 is 270 crores. This number was 243 crores for the quarter ending September 21, and for the quarter ending December 20, it was 184 crores. We clocked a market share of 10.4% in the cash segment for the period for the quarter December 21. This is a tad lower than 11% which we got in September of 21. Some sense of the market EDV. The total daily volumes for this quarter was at 38,75,000 crores. Out of this, derivatives, the options market was at 37.3 lakh crores, cash at 51,000 crores, and futures at 92,000 crores. The growth has been the biggest in the options space, whereas cash and futures have seen marginal or flat kind of numbers. I'd also like to share some information on some of the digital initiatives taken at Kotak Securities. The DIY journey of account opening for accounts in Kotak Securities has been enhanced significantly. We've reached a level of an account being opened in close to 6 minutes. The second big thing which we introduced in the quarter was a pre-login application of IPOs which were allowed to be done, which was not there in the previous quarter. This made a reasonable difference to our market share in the IPO space, and we see this going ahead as well. For derivative trade, the launch of the Nest platform has helped a lot in the stability of the platform and a reasonably large enhanced customer journey and experience. We launched our new trading website with the latest technology stack with cutting-edge UI and UX. From a service initiative, a multilingual chatbot in 9 languages, self-service options were launched, and we migrated our telephony to cloud with, again, multilingual IVR capability, enhancing customer inbound call experience. With this, I'd hand over to Manian to talk about the investment bank.
Hi. Kotak Mahindra Capital Company clocked for the first time in its history a profit after tax of over 100 crores this quarter. It was involved with marquee IPO transactions in the market, and we remained a go-to investment bank in the ECM side of the business. So what is even more important is that our advisory business is also in very good shape, and we have built a good franchise on the advisory side. In fact, even on advisory, we should end this year at close to record levels. Last year was a record year. This year, again, we could end almost at the same levels. So the investment banking business, both on the ECM side as well as on the advisory side, seems to be in good shape, and we have mentioned some of these marquee transactions there for all of you to see. Coming to Kotak Mahindra Investments, this is a company which is largely into real estate lending business, corporate real estate lending business, or structured corporate lending transactions. As you can again see, this has grown significantly. I made an earlier comment on good momentum on the real estate lending side, and part of the real estate lending gets done in the bank and part of it gets done here. As you can see, robust growth here of close to 30% in the asset book. This is driven by residential real estate transactions as well as some other structured corporate lending business. We have also been able to maintain balance sheet quality here, and as you can see, the net NPAs have dropped to 0.4%. Basically, our lending policies in terms of focusing on cash flows and the right security and choosing the right projects has really shown results here. In this NBFC, we have been also able to reverse COVID provisions to the extent of 7 crore, given the fact that some of our assets which were at risk have actually been recovered. I'll now hand over this to Kannan to take you through Kotak Mahindra Prime.
Thanks, Manian. Kotak Mahindra Prime had a profit after tax of 254 crores this quarter as compared to 149 crores in the same quarter last year. Disbursements during the quarter have been better than the comparable quarter of the previous financial year, but continues to be slightly impacted by supply constraints faced by the manufacturers. Collections during the quarter has shown further improvement, and its collection efficiencies on demand are closer to normal times. During this quarter, Kotak Mahindra Prime acquired the retail car finance portfolio of Ford Credit. I'll now hand it over to Nilesh to take you through the presentation.
Thanks, Kannan. Good evening, friends. Let me take you through our asset management business for December 21 quarter. Our total average AUM grew 32% year-on-year to rupees 2.87 trillion. Our equity average AUM, supported by market bounce back, grew 67% year-on-year to rupees 1.41 trillion. Our total AUM market share increased to 7.4%, and our equity AUM market share increased by 40 basis points to 5.4%. Our SIP registrations as on December 31st, 21 were rupees 9.1 billion, and SIP inflows for the month of December were rupees 6.65 billion. Our SIP book and average AUM growth continues to outpace industry. We continue to serve investor requirements by launching active as well as passive funds focused on local as well as offshore markets across debt, equity, and commodities. We also remain focused on ESG investing as India's first signatory to United Nations Principle of Responsible Investing. Consequently, our profit before tax has grown 20% year-on-year to rupees 146 crore, excluding non-recurring gains of rupees 46 crore. Our total AUM across mutual funds, PMS, offshore, insurance, and alternate assets grew 23% year-on-year to rupees 3.86 trillion. Our relationship value across wealth, priority, and investment advisory grew 73% to rupees 6.49 trillion. I will hand it over to Jaimin Bhatt.
Thank you, Nilesh. Friends, any questions, clarifications, explanations? The whole team is here.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the questions assemble. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, we would request to rejoin the question queue. First question is from the line of Rahul Jain from Goldman Sachs. Please go ahead.
Yeah, thanks. Good evening, everyone. Just a couple of questions. First on the provisioning policy, the reversal that you've done. Can you just elaborate and explain the thought process? Is it led by the recoveries and upgradation that we had, or you generally feel that the kind of worst is behind us and from here on it should be a more normalized provisioning?
Jaimin, you want to go?
Sure. Rahul, it's like this. Yes, as we saw, the realizations have certainly continued to improve. The gross accretion of NPA has slowed down, and actually the realizations upgradations continuing to increase quarter on quarter. The restructuring requests coming lower, as well as the fact that as we saw the SMA2 numbers very much under control. So we followed a process, and if you look at the background of how the provision on COVID was created, it was based on a set of accounts which had gone for moratorium and whatnot. A lot of those accounts which were under stress actually are no longer with us. They've actually paid up all their dues into what was due at that point of time. So continuing to carry some provisions on that was something which we were not necessarily required. especially on the back of what's happening on the market with respect to collections. So we looked at the overall thing, and we've not taken back all of what is possibly we felt at this stage. Also considering the fact that there is the wave Omicron, which is the wave 3, which is going around in the market. But though it is less virulent, we did keep a cushion for that. And as we've seen, as against what we had 1279, we will continue to keep 1,000 crores at this stage. And of course, we'll keep taking stock of this every period.
Thanks, Jamin. Follow on. Given that now we are focused even on the unsecured businesses, which generally have a higher loan loss through the cycle. Let's say a year out or 2 years out, as this book starts to become more meaningful, subject of course your growth trajectory. Would we then take provision as and when it sort of happens, or you think building a buffer from now on would be sort of relatively more prudent?
Now it's like this. While we are growing the unsecured book even today, like the unsecured retail, which is your cash credit cards and personal loans, business loans, consumer durables, is still about 5% of my advances book. Even that, while that is growing on a lower base, if the newer thing goes bad, we certainly end up providing that, and our provision requirements as a policy on the unsecured is far more aggressive than what the regulatory requirements are. So we'll take those hits if it comes, but right now it's looking fine.
Great, thanks. Can I just squeeze in one more question, more on the franchise side? So the customer addition has been pretty impressive. Can you just talk about the customer profile that you're onboarding, and also in the home loan business, is it all organic, or you've had some, balance transfer business also, coming to the bank? That is it from my side. Thank you.
Shanti?
Yeah. So as far as the customer acquisition is concerned, we continue to attract a lot of millennials and people in, let's say, from 25 to 40, but we are not restricting any customer. So across our channels, whether it's physical, digital, 811, we go and look for customers who, across all segments. But we are seeing a flow, like I said, if I were to put 25 to 40 is a good range to sort of look at the customer profile. On the home loan side, I don't know what you call inorganic as balance transfer, but that is also acquisition for us. Yeah, balance transfer has always been about 30% of our business historically as well as now. But we continue to see the primary market business flow is very strong. Manian had talked about the fact that residential sales are being really good, and we see that in the demand in our home loan business. So we have a combination strategy of primary market, customers buying ready-made property, secondary market sale, and balance transfer. It is a mix of all of it.
Great. Thank you so much.
Thank you. The next question is from the line of Amit Kariwala, Morgan Stanley. Please go ahead.
Yeah, hi team. Congrats on a strong quarter. I wanted to get some perspective on loan growth in the current cycle from a 2-3 year perspective. So there are two subsegments that I'm trying to get some views on. First is on corporate banking. And if I look at Kotak Bank this time, it's very differently placed in the sense that there's a sharp improvement in funding franchise, and one maybe is better placed to accelerate growth in corporate banking. Also, digital capabilities will be a key differentiator. So should one expect that as the pricing normalizes, which should happen as rate cycle turns, this time Kotak Bank would see much more market share gains in corporate banking? So that's part one of the question, please.
Okay. So Manian?
Yeah.
So is that you said that's part one? Is there a part two?
Yeah, which is on unsecured loans. Maybe I should do it after you reply. That's fine.
Okay, fine. Manian, you want to go for this first?
Yeah. Sumit, we have always stated that as if risk-return trade-offs work well, we are always open to growing the corporate book. at a pace that the market offers the opportunity at. Our key metrics has always been the right risk-return trade-offs. Our relationships are fairly wide. We have fair presence in most corporates, right from the top end to medium-sized corporates. Our coverage and presence is fairly wide, and we are fairly confident that if the secular growth in the corporate credit requirement goes up, we will be able to capitalize on that. And as I mentioned, our transaction banking franchise is also growing very well. And Santi also took you through the couple of slides where in the corporates we have used our new digital product, new online portal, new CMS platform. All of that is making a lot of difference, and we are quite confident that we can grow this franchise if the market opportunity allows us to do that.
Yes. Sumit, second question you had.
Yeah, second is on unsecured loan growth. And if I look at Kotak Bank's market share in unsecured personal loans and cards, there's some moderation of the past 3 years, and maybe rightly so because the macro was not good. How should we think about this unsecured loan mix going forward? And if I compare this to some of the large private banks, Kotak is relatively lower. So over the next 3-4 years, should we expect a meaningful jump? Yeah, that would be my second question.
I'm going to ask my colleague Deepak Gupta to really specifically answer on unsecured retail and the mix overall as a part of our strategic going forward. Deepak, would you want to give a shot at it?
Well, Sumit, there is no number which one has. Yeah, all one is trying to do is there is a great opportunity within our existing customer base. We have engaged with, at this point of time, only a small percentage of that customer base, and there is a massive opportunity for us to use analytics and expand that base through the unsecured side. And that is what we are after, and it will be progressively done. And remember, on the unsecured side, there are two separate sides. One is your unsecured, which is really the personal loan and the consumer durable financing and the business loan. That's one type of unsecured. The other side is really the credit card side, and that's a very different opportunity, yeah, because that is not just a pure lending opportunity. It's a very significant payment engagement, and for some of them, unsecured opportunity. Yeah, but it's a very significant engagement opportunity. So we'll drive all of that, and I think we're using a fair amount of analytics combined with some amount of experimentation to, drive that investment.
Okay, got it. Maybe I should stop there. But thanks a lot, Deepak.
Thank you. The next question is from the line of Adarsh Parasrampuria, CLSA. Please go ahead.
Yeah, hi again, Deepak. Question is on growth again. Just wanted to understand the last few years we've consolidated, and now we have benefits of cost of funds and lower share. Would now system credit be a constraint for us, or we are at a point where that 1.5 times or whatever the multiple is, you'll be comfortable consistently growing above that, and under what circumstances do you would want to put the brake again?
Yeah, I think I'll take that question. We feel actually we are coming into a sweet spot. I think our base case is we are moving into an endemic from a pandemic. We are very light in terms of the current risks we are carrying on our balance sheet. We don't have baggage. We have finally begun to get our analytics pieces in place. Our digital engines and a lot of the technology initiatives which were started are coming in place actually in the first half of calendar 22. So between now and June 22, a lot of our technology and digital initiatives on the lending side are also coming into place. And we actually feel that it's a good place to be. Our risk management skills are something we have got reasonable confidence in. And as this cycle moves, as inflation comes back steadily, as interest rates start moving up, with the positioning on our cost of funds and everything else, we have the ability to have an accelerator going. And I want to very clearly say that we are not constrained by the market size or the credit growth in the marketplace. We will be constrained by what we think is the right parameters. And therefore, as long as those parameters of our matrix get met, we will go for whatever it takes to grow our loan book and assets.
Got it. No, that's useful. And the second question is on the OpEx side, right? If you just observe most large banks, including yours, there's been a pickup in OpEx, partly due with the low base, partly due with business momentum coming back. But there's some accelerated tech spends as well, right? So if you take 2 to 3 years' time with added tech and spends and various projects, what would be, and with accelerating growth, would you still expect cost income to moderate, or we've come to a point where cost income for industry, for us, remains where it is in spite of better growth?
No, I think ultimately cost to income will get corrected, but we are very clear at this stage. There are 3 clear engines which we are growing. First is on retail loans, okay? And there are front-end acquisition costs. Just think about a home loan. If there is a fee for acquisition or distribution to be paid, a home loan which has, say, average life of, say, 7 years or 8 years, though the loan may be 15 years, average life is 7, 8 years, you're paying the fee cost upfront. And under banking regulation, you have to take the full distribution hit at the point of time you underwrite the loan. And that doesn't bother us because we are driven by underlying value creation, not necessarily what it does to my pre-operating profit in a quarter. That is not something which is the basis on which we take decisions. If we believe substantively it is going to add value, we are ready to take those costs upfront. But that is one. Second, I think you've got to keep in mind we have dramatically increased our customer acquisition from 8 lakhs in the last year, same quarter, to 21 lakhs in this quarter. And we see that engine continuing to fire. Again, that takes front-end costs. And we, of course, are very focused on unit economics of our acquisition cost on customers. But we think the acquisition cost upfront is not something which is going to deter us as long as we believe the underlying unit economics are strong. Therefore, that is point number 2. And point number 3 is with the opportunity in the marketplace, which is coming in, with our overall balance sheet matrix, we will drive growth, and we believe the cost-to-income ratio will be an outcome rather than a target. Therefore, we think about getting the right outcomes, which will improve the cost-to-income ratio because a lot of our costs are front-end. And also keep in mind that as we get more and more digitized, the actual straight-through processing digital lending transactions will ultimately reduce the effective intermediation cost as well. So these 3 or 4 parameters are what is going to drive us. And in simple language, first is really, I think the front-end cost thing we are ready to take. Second is we are growing our customer base at a very high speed, keeping in mind unit economics versus front-end costs. Digitization will ultimately make straight-through journeys significantly lower operating cost. And fourth, cost to income for us is an outcome, not a target.
Thanks, Uday. And I'll just squeeze in one last question. The last 2-3 years as our liability franchise has improved and cost of funds has drastically come down, we've kind of had an advantage of growing slowly. So the pressure on branches to raise resources, financial resources, has been low, right? When you get to high growth, and we've now run rates is north of 20% growth, we need to raise more money, right? It kind of puts more pressure, offer more on TDs at some point. So how does that equation change from
almost zero growth, no growth, getting to 20-25% growth, that adds to some pressure on margins or cost of funds, both on absolute and relative basis. So
I think we are confident about our liability franchise and the strength of it. And that does not mean we can afford to be complacent. We are driving the liability engine. We know there are the gaps as I speak to you, and there is a significant internal focus, energy, and introspection going on how we get the liability engine firing much faster as we go forward. And we are quite confident that we will get our execution on that as well, including digital is a very key part of our medium-term strategy, even on the liability side.
Got it. This is very useful. Thanks for all your comments.
Thank you. The next question is from the line of Kunal Shah from ICICI Securities. Please go ahead.
Yeah. So in terms of the growth, maybe in terms of the capital allocation or in terms of the opportunity, now almost home loan and LAP is equivalent to where the corporate banking is, and both of them are equally competitive. Okay, we were hearing that larger part of growth is coming from NBFCs, and most of them are doing it. So when we get to REROC, or maybe even in terms of the cross-sell opportunities in corporate banking as well as with the home loan customer, which would be the preference and where should we see a relatively higher growth? No doubt it's coming in from the home loan and LAP. We have scaled it up. But here on, how should we see between both these product segments?
Kunal, let me just reiterate to you. Yes, home loan and LAP in absolute stock terms is high, but on a growth rate basis, there are other pockets which are also catching up significant pace. Therefore, if you look at our unsecured retail, though of a small base, is growing at about close to 15% Q on Q. That's on a very small base, but that is catching up pace. So yes, the mix is still very low, which enables us to grow at a much faster rate. And that does not mean we don't like home loans. We like it a lot. We like the wholesale banking business. And you have to look at horses for courses, risk-adjusted return. And with our mix of 60% CASA, our cost of funds is a significant competitive advantage. I would like to believe probably best in class. And we will hammer that cost of funds advantage to get significant customer engagement and produce our risk-adjusted returns in totality. And keep in mind that in the COVID period 2020, a lot of our assets were actually in treasury assets, which were earning 4.5. And as that mix changes to even 6.5, 6.6, 6.7, it's still a significant mix change in favor of improving NII and NIMs. So we think we will be able to get the right mix. And one of the most important things we have learned in risk management is if you get your risk-adjusted matrix on a well-balanced portfolio with high focus on individual product segments, the outcomes can be significant and sustainable while being dramatic as well.
Sure, but currently, which one would be giving us a better return if I have to look at, say, home loans and corporate banking at this juncture on a REROC basis?
Home loan and corporate banking, Kunal, let me also give you this. Say on corporate banking, when we look at returns and home loans, we look at customer returns. For example, in corporate banking, as Manian mentioned, in addition to the spread in the lending business, we make significant flows on foreign exchange, transaction banking, deeper customer engagement, translating into broader relationships, including with our investment bank. So there are a whole host of linkages in the corporate banking business beyond just the lending product. Trade is another very major part. Current account growth, all that is deeply interconnected and integrated to the lending piece in the corporate banking. And therefore, I would request look at some of these as engines for customer returns. Similar for home loans, we think home loans is one of the most sticky products in a customer's journey, and the ability to cross-sell a variety of products to a home loan customer is also a significant opportunity. A home loan customer who has got a core mortgage is a much safer customer to add a credit card or a personal loan. a home loan customer who has an engaging bank account, that again gives us a deeper engaging relationship with that customer. So we are getting significantly more focus on customer engagement and customer return in addition to making sure that the product makes economic sense.
Sure. And second, in terms of ECLGS pool, how the behavior has been. So it's been 9-12 months. So if you can highlight and any risk or we are seeing a much better collections equivalent to the overall portfolio. How is the overall behavior of that?
Manian, you want to go for this?
Yeah. No, so the ECLGS portfolio, we are not seeing any significantly differential behavior compared to our normal portfolio. And there is therefore no perception of any enhanced risk coming out of this.
Sure. And one last question in terms of investment portfolio, given the size and the movement in yield, the knock seems to be slightly on a higher side. So have we protected ourselves for any further movement, or maybe have we reduced the duration during the quarter and it was relatively higher in Q3? How should we look at it? And maybe any further movement of 30-50 bips, how could be the impact now on?
Kunal, we have put down on paper what our duration is. We have put down on paper what our HTM is. Okay, we have put down our balance sheet in front of you. So it is pretty straightforward that the pain is behind and we are actually in a pretty comfortable zone as we go forward. Of course, it depends on the amount of yields. Therefore, even in a 1-year paper, if the yields move up 150 basis points, there will be some impact. But at duration of around 1.5 years, we think we are in a very sweet spot in a rising yield environment with a CASA ratio of 60%.
Sure. Thanks a lot.
Thank you. Ladies and gentlemen, please limit your question to 2 per participant. Should you have a follow-up question, would request to rejoin the question. The next question is from the line of Gaurav Kochar, Mirae Asset. Please.
Yeah, hi, good evening. Thanks for taking my question. Just extending the question that Adarsh asked earlier, regarding pressure on NIMs if the growth comes back. Just wanted your thoughts around, SA balance, especially, last 18 months, ever since we've cut down on rates. The SA traction has slowed down a bit. So, and given that we have been spending on tech and on liability acquisitions in the last 18 months, what kind of outcome do you expect from this? Given that in the last 18 months, the SA traction hasn't been very, or the growth has tapered off a bit. So outlook on SA in the next maybe 2 years, and in that context, if I look at the growth in overall balance sheet was just 2.5%. So it seems optically because the overall growth in interest earning assets has been lower than loan growth. There was a positive uptick on margin. So going ahead, given that some part of excess liquidity is gone, how should we look at margins? Should we assume that the deposit growth would broadly mirror the loan growth and hence could have some impact on margin? Just wanted your thoughts around.
I'll answer the second first and then ask the first to be answered by Shanti. So on the second question, it is a wonderful. The way you need to look at it is we have gone for what I call as a asset mix change in the last 12 months. The asset mix was first when COVID hit us in April 2020. We loaded up on fixed income government securities assets. Okay. And of course, they were lower yielding and we were carrying huge amount of surplus liquidity. We are now, it's a very clear mix change. It has gone into customer assets and loan assets from treasury assets. So that mix change has taken place. So you may not see the same level of growth in the balance sheet as you would see in advances because it's a mix change in the asset profile which we are carrying. So that is point number 1. And that actually is a big positive for our earning and spreads because even if you take the lowest yield asset in that sense on the retail side, which is say a home loan, 4.5 asset is moving to a 6.5 asset as a very simple mix change which is happening. And we are still carrying, as you can see, 130 to 140% LCR. Therefore, we are still in a very comfortable liquidity position even now. Now, as far as your first question is concerned on savings accounts, I will ask Shanti to answer that and give you a perspective of what we are doing as we go forward. Shanti.
Yeah. Thank you, Uday. When we dropped off 6%, we sort of dropped it off in a relatively short period of time. And it has taken us time to replace the value proposition for the customers, like many other banks have. And if you saw some of the OPEX, we have sort of stepped up our engagement through, offers, propositions, type with Apple, Flipkart, Amazon, etc., which has increased the engagement layer of the customer. So the increase in engagement layer is something that we have, stepped up. It has taken us the last 6 odd months to build it, and we are well on that journey. Yeah. Last year, our new to bank customer acquisitions was impacted because of COVID, but that has stepped up, and we have again, gone for very aggressive acquisition, which is what gives you the kicker. We missed out the kicker we would have got last year on the NTB, as I call it, which we have restarted the program. The third thing is that, we are still very largely retail focused, and we don't have a large institutional business, right? Particularly the government business. As you now know, agency bank has been extended to all. We have got approvals for GST, for CBDT, for, PPF and a lot of other things. So we are building the whole government business model, including at the wholesale and the retail end, to be able to sort of, support the growth. So 3 parts to the strategy. Our retail model continues with aggressive acquisition, but deeper engagement to replace 6%. Second is really the aggressive NTBs, which will build value over a period of time. Focusing on building the institutional business now with the agency business having opened up. And these are some of the steps that would sort of focus on getting us back to SAR growth, which has been relatively slower in the last 3 quarters.
Understood. Okay. And my next question is on the MTM loss. Just wanted to clarify, is there any provision on security receipts or markdown of security receipts in this quarter? Because that number of 484 crores, taking 62% AFS with a duration of 1.5 doesn't add up to the investment portfolio.
Jaimin?
Sorry, I was on mute. No, the 484 doesn't really have any SR related hit. That's entirely coming out of the non-SLR and SLR bond book.
Okay. Because if I look at FY21, the entire profit from treasury was 270 odd crore. And in this quarter, the loss is around 484 crore, which is almost 2x of the profit last year. So this number seems a little higher. Has the modified duration changed versus FY21 for this book? As a result of which the loss seems high, or just wanted to understand?
Yeah, I think we have definitely moderated duration. That is clear. Okay, we have moderated duration.
Okay, no, my question was if the duration was high in FY21 and moderated, ideally the loss should have been lower. But
it has been moderated over time in the last few months. Okay, so that is so obviously the rates started going up, as you know, October, November onwards. So we have moderated the duration. We have taken that call. And second, I think you got to keep in mind that there is a concept of pull to par. Therefore, if I bought a security, originally government issued security of 7% coupon, and which last year was trading at 4.5%. There's a pull to par impact, while the NII on that comes in my top line. So that pull to par impact is also a part of the MTM provision. I hope you get the point. Because that security was bought at a premium. Therefore, 7% security, if it's bought at a 4.5 yield, right, the security is bought at a premium to par. So the premium to par has to be marked down on that security, which is also a part of the reason why 484 has happened.
All right. Understood. Okay, thanks. That's it from my side.
Thank you. The next question is from the line of Abhishek Prarka from HSBC. Please.
Yeah, good evening, everyone, and congratulations for the quarter. So
Two questions. The first is on NIM. So basically starting with the cost of SA that you've reported, it's down 19 bits QOQ. I'm assuming this is the impact of the SA rate reduction that you probably did around October. But how much more repricing is there to go in the SA book? That's one. And the second part is, you've raised your TD rates a bit, and generally your concentration of deposits is more in the less than 1 year and 1 to 3 year bucket. So how soon or how much time can pass before it starts showing up in your cost of funds and your cost of funds starts going up?
So first of all, on SA, now the rates we have are a uniform 3.5.
Yeah.
We believe that if you look at some of the larger banks, they are at 2 at 2.75 and 3 at less than 50 lakhs. So we believe that as interest rates start moving up, we don't need to increase our SA deposit rates, particularly since our lowest is 3.5. There are banks at 2.75, there are banks at 3. So we think the pressure on SA in terms of just rates will not impact us for a while. That is point number one in terms of our need to be doing anything on SA. And I think on TDs, we are quite comfortable with, TDs you just have to do, our view is that a 10 to 20 basis points pricing difference and you start getting a reasonably good flow on TDs when we need to open the tap. And we will consider it appropriately. We have also, just to share with you, we have taken significant fixed rate refinance on some of our liabilities in the last 3 months. So at about average maturity of 2 to 3 years. So from some of the institutions. So we have actually taken a conscious decision in the last couple of months to step up on our refinance, our fixed rate refinance from the institutions on the book, and simultaneously the duration of our bond book is also got significantly lower. So we think we are reasonably comfortable on managing margins and getting growth. And you also keep in mind that even if there is some shift in the mix of our loan book, in one from treasury assets to customer assets, and second is some change in the mix on unsecured retail, that will also be kicker to our NIMs.
So what you're essentially saying is that you've got enough levers to keep NIM at 4.6, and that should be a sort of run rate.
I'm not saying that. I'm saying that we have enough levers to have a very good NIM management ability.
Okay, understood. And my second question is on fees. I just wanted some granularity on this other fees. So the reporting is minus 132, and the loss in MTM was 484. So that gap of 350, what are the components of that gap?
Jaimin?
Yeah, I'm sorry, I didn't get you on the...
No, what are the components of that? So one thing you want to explain is that provisioning thing.
Okay, I'll come to that. So there would be things like, there will be prop activity relating to the whole area of fixed income as well as the derivative side. So that's the fixed income side. The other income would also include what we sell on the priority sector certificates. And there are pockets where we have excess and we actually trade in PSLC. While when we buy, there would be an expense item, but the entire gross amount of what we sell is sitting in the other income. That would be a positive number. And also there are our stressed asset division buys and sells assets. So there is some income coming from the stressed asset division. So if you look at the corresponding number in the previous year, the minus 132 was something like 170 positive. So 132 negative is after the hit of 484, which is on that count.
Does dividend also sit there? Dividend and forex income?
There is no dividend from subsidiary in this quarter.
Yeah, but it would come in that line.
It would come in that line, yes. There would be something if you look at a 9-month number in quarter one, but not in this quarter.
And forex and derivative income also comes there?
That would come here, that's correct.
Okay. Got it. Thank you so much, Jaimin, and all the best to everyone for the next quarter.
Thank you.
Thank you. The next question is from the line of Nilanjan Karfa, Nomura. Please go ahead.
Hi. Thanks. So brought two sets of questions. One is on IPO financing. Now that's something that's going to go away from March onwards, right? Could you talk about how? I'm guessing that's a reasonable part of the book, and definitely gives you good margins and income. So how are we trying to sort of mitigate that impact, if any? Does that also have some kind of impact on your overall deposits or average deposits? So that's
Manian, you
one.
want to answer that? Manian, you want to answer that?
Yeah.
Okay. You said you have one other question, so go ahead, sir.
No, I can take it later.
Manian?
Yeah. So as you know, RBI had asked bank-owned subsidiaries to not do loan against shares and IPO financing of that, and therefore there is no IPO financing profit built into these quarter's results. They have been stopped in the main bank or its subsidiaries. The associate company Infina does loan IPO financing, and that comes in the consolidation as part of the Infina's profit being consolidated into this. Otherwise, the main bank and its subsidiaries have no IPO financing business.
It's not there currently at all.
No, not at all.
Okay. But does it impact the deposit side also, or because of the way it is usually structured?
No, not too much. No, nothing significant.
Okay. Right. Second question.
As you know, IPO financing business had moved to term deposit model. If you know, the money was lying in term deposits and very short-term term deposits, so it doesn't have too much implication on the deposit side.
Right. Okay. Second question goes back to the unsecured piece that we are talking about. I mean, look, I think we are a reasonably smaller player, but the market is also very well penetrated, right? How do you think you are going to gain, market share? Is it going to be more organic? Is it going through more penetration? And already we are, taking in a lot of costs. So is that something that will continue over the course of next 2-3 years?
Once again, I'll ask Deepak Gupta.
No, I mean, that's pretty easy given our small base. I think it is pretty comfortable to grow from that small base. And like I said earlier, we are really looking at the whole unsecured piece essentially from our existing customer base. And within our existing customer base, our penetration on the unsecured side is practically negligible. Yeah. So it basically means that we don't really have to go out to get the growth which we are really talking about. So I don't think it's a problem really. Yeah.
Deepak, just wanted to clarify. I mean, it is generally felt that our salaried franchise is a little less, or at least the market perception is the salaried unsecured piece is something that where you earn your margin and have lower losses. Are we sort of disadvantaged on that front?
That's a misconception. Yeah. We have reasonable new salary accounts which keep coming in, and the stock of salary accounts is pretty large. But the unsecured is not only to corporate salary customers of which are acquired through that route. Yeah, there are large customer acquisitions which are happening, which are salaried customers with their corporate salaries with other banks also.
Okay. Fair enough. And a quick question to Jamin. Jamin, could you clarify at least, either now or any time in the call, the items of, MTM provision on AFS, the trading or treasury gains, and recovery from return of items. These three items for the last, let's say at least on a YOY basis or at least previous quarter as well. And net interest margin and total deposits on a consolidated basis. Thank you.
Hello, Jamie?
Sorry, I can share that with you separately, Nilanjan. That should be
Sure. Thanks.
Thank you. Ladies and gentlemen, that was the last question. I would now like to hand the conference over to Mr. Uday Kotak for closing comments.
Thank you very much, colleagues. We have spent nearly 1.5 hours. I really appreciate your time and a very frank and candid discussions. And I do look forward to hopefully a better situation in the post-Omicron period, as most people seem to be getting it, and the current lethality of that is much lesser than any other earlier forms of COVID. I do feel that we are getting into 2022 with new risks and new opportunities. And there are some things which are changing. And from a Kotak point of view, if there are three most important things in terms of our driving for the future, it is customer acquisition and customer experience, which is point number one. Second is significant investment and growth in the technology piece. And the third, and I think the most important, is getting the right talent for a new future in financial services. And all three are very major focus areas. And I would like to share with you that we are moving in all these three areas at great speed. Thank you very much and have a wonderful weekend. And goodbye.
Thank you. Ladies and gentlemen, on behalf of Kotak Mahindra Bank, that concludes this conference call. Thank you for joining us, and you may now disconnect your line.